Good morning, everyone. My name is Bruce Lynn. I'm one of the managing partners of Fiscal Executives Consulting Group. We're going to start the main body of our presentation, today's economy and the promising side of bankruptcy, in just a few moments. We've got a good crowd for today, so I want to give everyone a chance to log on and get settled in. For those of you who are online, you are in mute-only mode, which means that you can hear me, but I cannot hear you. We have a formal presentation this morning, but if you have questions during the presentation, please type them into the question box on the lower right-hand side of your screen, and we'll get to them afterwards. We're going to try to wrap up in an hour, but if we've got enough questions and everybody is willing, we can go a little bit past the hour. I realize that people do want to get back to work, and there may be other meetings scheduled. So we'll try to keep it to an hour, but if we go over a little bit, not to fear, things are being recorded so that you can listen to the recording at your leisure, and you'll get copies of the slides in the next 48 hours or so. So I am going to go away, let the people log on, and we're going to start here in about another 2 minutes. Well, good morning, everyone. My name is Bruce Lynn. I'm one of the managing partners of the Financial Executives Consulting Group. We're going to start the main body of our presentation in just a moment. This is today's economy and the promising side of bankruptcy, brought to you by Bloomberg Intelligence. The webinar is scheduled to last for about an hour. If you have questions during the formal part of the presentation, please type them into the question box, on the lower right-hand side of your screen, and we'll get to them after the main body of the presentation. If we don't get to your questions, or if you have to leave early, please send me an email, and you will get a copy of the recording later on, so you can look at those parts that you've missed. Again, if there's questions you want to ask that you don't want me to read out loud, please type them into the question box. Please send me an email, and we'll take them offline. So with that, I want to start the main body of our presentation. And to do that, I want to sort of just mention today's speakers from different parts of Bloomberg Intelligence. Obviously, we're going to start off with the economic part, and then go from there into the part about bankruptcy, which again has some good parts as well as bad parts to it. And then talk a little bit about the tax implications of what you've seen. So we finished the introduction. We're going to start with the economics and go through the different parts in this order. So before I start, I just want to give you a small update about what is Bloomberg Intelligence. So this certainly is an area that is a good source of information for things that are happening. I think that you have to consider in today's world, it's no longer sort of a steady state. So keeping up to date is what you want to do. And as you can see here, BI covers many industries and thousands of companies so that you can see all of your information in one single source. Okay, so with that, let's start with sort of some economic projections. And with that, I'd like to turn it over to Yelena. Yelena, are you there?
Yes, thank you, Bruce. Can you hear me well?
Yes, I can.
Excellent. So my name is Yelena Shulyateva, and I'm a senior U.S. economist within Bloomberg Economics. We are a parallel group to Bloomberg Intelligence, but you can find all our research on the terminal. And at the end of my presentation, I will also mention the details of a phone call that we conduct on a weekly basis, and everybody can join us on Monday morning at 8:30 when we provide an update on the state of the economy and the state of the markets. So I'll do it at the end of my presentation, but right now I would like to talk about the US outlook for this year and going forward, and discuss some policy prescriptions that we have already seen and that we are going to see in the near future. So before we get into the details of the outlook, I would like to note a couple of things. So first of all, that the current shock that is due to the coronavirus outbreak is completely different from the recession as we know it. The recessions in the past, especially in the post-World War II period, they were due to imbalances in the economy, for example. They were a result of financial shocks, such as the most recent one, but nothing like this was ever evident before, frankly. This is completely an exogenous shock that we are experiencing right now, and for that reason, there are so many different things about this current recession that we observed in the past. So a couple of things also about the policy response, and we've heard a lot from policy makers recently in the last few weeks in particular with respect to how they would like to respond to the economic contraction and what tools they have. So the nature of the current crisis complicates the things tremendously. So first of all, because this outlook depends on, and I'm quoting Chair Powell, unknowable questions about the coronavirus itself. So we simply don't know how long it will last, how quickly the vaccine will be developed, and whether it will be available on a broad-based basis. So because of that, the economic consequences are also unknowable. So that's one thing. And another thing is that it seems like there is a growing sense that this recovery will be much more slower than the recoveries in the past, and then like a lot of people are expecting. So one thing that will complicate things really is the uncertainty surrounding this outlook about the virus itself. So unless we actually know how and how long it will be staying with us, frankly, then a lot of people will just simply not be confident in the outlook. So that means they will be cautious spending money, they will be cautious investing money in their businesses, they will be cautious hiring people. So this all means that the outlook is really, really uncertain. So but let's just jump into the key features of our expectations about the economy. So first of all, we at Bloomberg Economics anticipate a very sharp and deep contraction. And this contraction will last for a very short period of time. So peak to trough contraction is actually expected at 12%. And this decline far exceeds the contraction that we observed during the Great Recession back in 2007, 2008. So that will mean that the labor market will be in a very terrible shape. We already observed what happened back in April in terms of the payrolls report. We saw the unemployment rate rising to almost 15%, and we expect further increases in the unemployment rate in May. We think that the jobless rate will peak at something like 20%. This is way higher than what we observed during the Great Recession, and it's more akin to what we last witnessed in the Great Depression era. So that means that inflationary pressures will be non-existent. It will be deflationary pressures. We expect inflation to turn negative and remain negative through the first quarter of 2021. So in terms of the recovery, obviously we are still talking about a contraction because it's still ongoing, but a lot of focus from the financial markets has currently been on the recovery, and that's not surprising because states are starting to reopen. They reopen at different paces, but in our view, it will not be a V-shaped recovery. It will be more likely something like a long and shallow U, and I will demonstrate it later in the slides why we think this will be the case. But let me just tell you right away that uncertainty again will play a key role in shaping the kind of the future path of the recovery. So in terms of policymakers, we expect more on the fiscal front. We expect more from the Fed in terms of monetary policy, even though the Fed has been slowing the pace of QE purchases every week now. Actually, they are still working on a wide range of programs, credit programs, and that's where we think the focus of the Fed will be in the next few months and quarters. We expect the balance sheet to rise in size tremendously, topping 50% of GDP by year end, and we don't think interest rates will go much higher from where they are anytime soon. So let's move the slide and take a look at the forecast table. So here we outline a few different scenarios, but today I will focus mainly on the baseline scenario. This is the blue numbers in the table. So as you can see, we expect almost a 40% contraction in GDP in the second quarter, in the current quarter of this year. And that will be followed by a smaller rebound in the second half of the year. So 16% in the third quarter and about 7% in the fourth quarter of this year. So again, excuse me, the contraction that we are experiencing right now is not going to be rebound. The economy will not rebound to the full extent right away, simply because there's so much uncertainty surrounding consumer outlook, business outlook, and trade and other sectors of the economy. So that will mean 2020 will witness an almost 7% contraction in terms of fourth quarter over fourth quarter, and 2021 will see a partial recovery from there. So you see the unemployment rate in our projections is peaking at 18% in the second quarter. On a quarterly basis, I mentioned earlier, we expect 20% unemployment rate in the months of May, and that is not gonna fall below 6.5% until probably 2022. So we see the Fed not raising rates for the foreseeable future, obviously, and then also we expect the balance sheet to stay quite quite large for the foreseeable future. Let's move the slide, and this is how it looks in terms of different scenarios. So again, our baseline is the blue line in the chart, and we do not see the economy going back to where it was before the coronavirus crisis anytime earlier than 2022. So as you can see in the chart, by the end of 2021, we're still way below the level that we were before the crisis. So that's why we call it not a V-shaped recovery and a long and shallow U. Let's move the slide. So this is something that I mentioned right in the beginning, that the depth of the current crisis, we roughly estimated peak to trough decline of 12%, and this is the pink line in the chart. And if you compare it to the Great Recession, peak to trough decline was 4%. So the current one is roughly triple in size. And the next slide shows the length of the recession. So you typically see the recession lasts 4 to 5 quarters, and that's the yellow bar in the slide. But the current one is estimated to only last 2 quarters, but exceed other recession in depth. Okay, so let's move on, just for the sake of time. So one of the key components of our source data for us to project GDP growth is high frequency indicators such as jobless claims. The jobless claims data have been really useful in terms of trying to estimate the pace of the contraction and eventually the pace of the recovery in almost real time. So these data come with 1 week lag, and they have been very, very useful to our projections. So as you can see in this chart, that we use continuing claims data to really forecast economic growth. The data have been very useful in terms of predicting the depth of the downturn as well as the timing of the downturn. So this shows you the data back in 1980 to 1995, and you see that that predicted quite precisely the troughs in the data. So let's move on to the next slide and look at more current history. So again, here you see the period of the early 2000s, and these data were able to accurately predict the trough in economic growth in both of the recessions of the 2000s. And one more slide of the same with the same indicators. Let's move on to the next one. Here you can see the most current history, and the reason I didn't show them on all on one slide is just because the depth of the current crisis just basically messes up the whole scale of the chart. So, but it shows you that the current surge in jobless benefits implies roughly 60 to 70% contraction in GDP. So obviously we will see jobless claims data improving from what we now think is going to be the trough of economic shock. So say by the end of June, we will see continuing claims recede somewhat. So that's why we estimate contraction in the current quarter will probably be roughly 40%. So that continuing claims data will just be a little bit less severe by the end of the quarter. But this is what it would have predicted at the very trough of economic activity. Okay, let's move to the next slide. This is the previous one. Yeah, okay, excellent. This is just another depiction of what happened in April in terms of jobs growth. So basically, everything that we gained in terms of jobs from the trough following the Great Recession was lost in 2 months, in March and April. And then it will be just very difficult. It will take time to go back to where we were before the crisis. So, and the next slide also shows the same point, but we talk about it in terms of two different bars. So on the right-hand side, you see that in March and April, we lost more than 20 million jobs. And that is comparable to the amount of job losses if you just combine every single recession from 1960s on and put them together. And this is how many jobs were lost only in 2 months. So this is very much unprecedented in terms of job losses once again. Okay, let's move on and talk about the recovery, and that's what everybody wants to talk about right now. So we at Bloomberg Economics created a few dashboards, basically trying to track the most high frequency indicators, because a lot of economic data are monthly and they come up with a significant lag. But there are other very high frequency indicators, and I mentioned some of them, such as jobless claims that come out weekly, that can help us to more quickly predict the turning point and to see what will happen going forward. So as you can see from the dashboard, some financial market indicators already kind of turned the corner, so they're not as red on the dashboard anymore, and that's quite usual. That's quite common for financial market indicators to be the first ones to turn. But in terms of real economic data, we see a slight improvement in terms of jobless claims already, and I suspect as we go forward, we will see some improvement in terms of public transportation usage, airline passengers, and so on. I would just suspect that we are not going to see a quick turn. It will just be, as I mentioned, shallow and will take time to improve. Let's move on. I just would like to cover a lot of policy questions, because obviously a fiscal response and monetary policy response are key to defining the future trajectory of economic growth. But before we get to fiscal policy, which Andrew Husby, my colleague, will talk about, I would like to stress one point here, that the shape of economic recovery and the strength of economic recovery going forward will largely depend on consumers. It will depend on how consumers are faring in this very uncertain environment. This chart that we have here shows that before the crisis, the consumer sector, personal consumption, was the largest part of economic growth. It was driving GDP growth, and it was the largest part. So I would suspect that this will be the biggest part once again in the recovery. because business fixed investment will probably lack. There's simply no money the companies can invest right now. There's a lot of business uncertainty about what is going to happen. So a lot will depend on the consumer, and obviously the consumers depend on wages. So that in turn means a lot will depend on the health of the jobs market, the speed of the recovery in the labor market, and how much wage income it can generate, so that we all as consumers can spend money and move the economy forward. So with that, I would like to skip the next couple of slides and go to the fiscal section. And I would like my colleague Andrew Husby to talk about the fiscal package and what to expect in terms of further stimulus measures. Let's move a couple of more slides forward. One more. Excellent. This one. One back.
Nope.
Perfect. Thank you very much. Andrew, turning over to you.
Okay, thank you, Yelena. I will spend a couple of minutes here. Clearly, the unprecedented and rapid economic shock has required a very significant fiscal response. And clearly, while this is both the deepest recession ever, this was also we're entering a period where deficits and debt to GDP will be rising rapidly as well. So, just circling back a minute, we did not include a slide on some of the detail of some of these packages. Potentially when the slides go out, we can add one more in there. But just briefly, obviously the key in all of this has been to offset the income shock to households and businesses, to effectively prevent a short-term shock that's been engineered in order to deal with a public health crisis from evolving into a much more persistent shock where you see rolling bankruptcies and effectively a much sharper retrenchment in consumer spending after the economy reopens. So the response has been very quick, certainly compared to history. It's certainly not quick compared to the timing of the shock, but the targeted increase in unemployment insurance, payments to households, loans turned grants to small businesses, and a rapid expansion in the Federal Reserve's lending capabilities has really come in a very short period of time compared to historical recessions, when you normally see stimulus packages being implemented when the economy is already beginning to recover. So this is coming during the shock. We do see more on the way later this year. Most likely, sometime in June, we'll see serious discussions on the next round of stimulus. Currently, we've got about $3 trillion worth of stimulus. The number can move up or down based on what you assume about lending capacity for certain allotments committed or authorized, rather. So what we're looking at, though, is probably another trillion and a half bill, most likely split roughly evenly across more aid to small businesses via the PPP program or some equivalent. There's still some debate about whether that was sufficiently well structured. So we do expect, though, more to small businesses. We expect another round likely of targeted basically stimulus checks combined with an extension of the unemployment boost, the $600 per week boost to that benefit. We think while there will be a good deal of hemming and hawing over that, we do know that both parties will be eyeing the election later this year, which is obviously a key event that will be again entering their thought process. So in addition to that, we'd expect something on the order of say $500 billion of aid to $500 billion of aid to state and local governments. That's also been a sticking point, but we do think that does come online. So what that does do, again, you'll see this deficit chart first, and then in a minute we'll flip to the debt chart. But you see effectively a response, both based on the increase in outlays and the drop in revenues that really blows out the deficit to effectively wartime levels. You'll remember the scenarios that Yelena talked about for the economy, and we've run the numbers, both the economic impact and the additional stimulus we expect in various scenarios. And what you do get here is, the blue columns are our baseline. That does incorporate that roughly $1.5 trillion into next year of added programs, plus the economic profile we're looking at. And then you see some alternative scenarios. And basically in every case, the deficit has a difficult time returning below 10% of GDP, both due to economic weakness and more persistent increase in outlays. So clearly, markets are not worried about this now. The bond vigilantes are quiet. The Federal Reserve is buying, which you'll get to in a slide or two later. So let me go to the next slide here. And this just shows the increase in debt. Once again, this is federal debt held by the public, rapid rise, really unprecedented. Once again, outside of it's unprecedented post-war, and it's the only comparison recently is the wartime period in the 1940s. So clearly the response has been quick. And the one last point I'll make is that this really has illuminated the extent to which the Treasury and Fed are working together on this. Recently, both the Treasury Secretary and Fed Chair Powell were before Congress giving a testimony on the CARES Act, and you really see there's not explicit cooperation, but you see they've been working together. There's in a minute I'm going to hand it off to Yelena again, just to quickly go over some of that, but the expansion of the lending programs do require, or at least have come to require, some support from Treasury. So in terms of a capital allocation, so there is quite a bit of cooperation, not explicit, because that does get into some issues of Fed independence, but we do expect that the Fed chair will certainly be entertaining some politically charged questioning from Congress in months and quarters ahead as more details of the lending programs come out. Who's getting money and who is not. So it could be an interesting period there. So Yelena will have a little bit more on the balance sheet, and then we'll pass it along.
Okay.
Yelena, back to you.
Thank you very much, Andrew. So let's move the slide, and for the sake of time, I would really like to end our economic presentation here. But I can answer all the questions about monetary policy and the way we see it in the Q&A session. But just let me spend 1 minute here. Expect the Fed balance sheet to top 50% of the economy by the end of the year. And this will mainly be a result of expanding credit facilities the Fed is currently working on, and they are assessing the effectiveness of this new, relatively new tools for them. And obviously, QE policies will also add to the balance sheet, but again, they are adding at a diminishing speed right now. So let's skip the next few slides and let's go to our commercial slide here, next one. So I would like to just plug in a quick commercial and really to invite everybody who's listening to the call to our weekly economics and strategy update, which we conduct every Monday at 8:30 a.m. New York time. And here you see the numbers you can dial in, and it's a 30-minute call. We discuss all the current issues, the forecasts, and in terms of what it means for the markets, whether it's an equity market or a treasury market or an FX. So with that, I would like to turn it over to Nigisa, who's going to talk about bankruptcies.
Thank you, Yelena. My name is Nigisa Baluku. I'm a bankruptcy litigation analyst at Bloomberg Intelligence. Today, I'm going to speak a bit about bankruptcy as an option for companies in distress. at this particular distressing time. So to start off, it's helpful to think about how we got here. Aggressive corporate lending and macroeconomic stressors have left many companies weak and vulnerable, and probably the most vulnerable ones tend to have two things in common: large swaths of debt and very little cash. And many, like Neiman Marcus and J. Crew, for example, have struggled for years to pay back billions of dollars from leveraged buyouts. And instead of addressing the debt problem, the market has effectively kicked the can down the road via perpetual refinancings and out-of-court techniques such as debt exchanges and waivers. Next slide, please. For many companies struggling to maintain financial well-being in the midst of COVID-19 pandemic, seeking the protections of bankruptcy court may be the best option to remain viable. Bankruptcy law generally provides troubled businesses with a set of tools to help turn things around, and they can include things like the automatic stay, which freezes creditor payments, prevents contract parties from terminating contracts, or prevents landlords from terminating leases. And generally speaking, it tends to be a forum for flexible, speedy, and efficient negotiations on a relatively level playing field. Next slide, please. So we have to rethink some of the pre-bankruptcy steps that are critical in any restructuring. Of course, cash shortfalls are common in bankruptcy, and obtaining debtor in possession financing, DIP financing, is often necessary. In considering whether to organize, a company will often consider its ability to obtain and eventually pay down a debtor in possession loan so that it can finance its expenses of separation through the Chapter 11 process. DIP loans are generally subject to special protections under the Bankruptcy Code, which makes them a relatively safe investment, very attractive to lenders who can collect large fees. They are often granted super priority status. They get replacement liens and collateral. And even more importantly, they do have the ability to set specific deadlines, conditions, budget targets for the cases move forward. And these loans can be especially appealing to existing lenders who may be able to use a DIP loan facility to convert their pre-petition debt into post-petition debt with a higher priority. However, what we've seen recently, debtors suffering from covenant defaults or near covenant defaults under their DIP loans, and we suspect that may make lenders more wary of extending such financing, and which would in turn significantly decrease the availability of DIP loans in the marketplace. Sanchez Energy, for example, is a recent example of that. There, the debtor announced an agreement with the DIP lenders to entirely equitize the DIP claims, which turns out to be a substantial downgrade from the lender's expected payment in full. So it means that now, even when lenders do extend DIP loans, they will likely insist on terms that less favorable to the debtor. It's generally an issue that companies contemplating reorganization will probably pay a lot more attention to. And along the same lines, while DIP financing was said is almost always necessary, there are exceptions. And an interesting tactic that some recent debtors have pursued is to take advantage of existing revolvers. So in Whiting Petroleum, for example, the company drew down $650 million on its RBL facility just days before filing, obviating the need for DIP financing. The banks honored the request. At the time they did, they weren't necessarily aware of the upcoming bankruptcy filing. Now, could they have objected? Sure, though that tends to be uncommon for RBL facilities. So it's just something that is interesting, and we see companies using when they can, and probably will continue to do so. Valuation of cash collateral may be another issue that more companies contemplating bankruptcy will probably face before they file. Under the bankruptcy code, a debtor may not use a secured creditor's cash collateral without the consent or without the creditor's consent or a court approval. So if you take a company with an all asset secured debt, for example, this means that all of the companies, that means that includes all of the company's own cash. And that consent or approval is only obtained by providing the secured creditors with what we call adequate protection. Could be many things, and basically protecting that creditor for the risk that this collateral will be diminished in value over the course of the Chapter 11. We have very minimal guidance under the Bankruptcy Code on how to, on valuation generally. So in times such as this, amidst such significant market uncertainty, such valuations can be difficult and can give rise to disputes between parties that are generally pretty costly and time-consuming, and it can involve very protracted litigation. Independent committees. So what are these? So these are committees that a company will put in place before filing and will have a very specific purpose. And usually it's often to investigate a potential claim or allegation against the debtor, which the debtor itself cannot do, it's conflicted from doing. This is a way that debtors can get ahead of any such claims. It can keep control within the company and hopefully avoid a prolonged and expensive dispute over who can investigate claims against the debtor once it enters bankruptcy. So an example of this is Neiman. The week before Neiman filed for bankruptcy, it appointed two, they called it disinterested managers, who had their own counsel. It was separate from Neiman. Now Neiman most likely knew before it filed that it would most likely face serious fraudulent transfer allegations. So with that in mind, it delegated the right to investigate those claims to independent managers within the company. And even though it files with massive creditor support, we see a company making sort of every effort to preempt any other creditor from pursuing separate investigations. We still don't know if the setup is enough. We don't know if it's going to work. We don't know if it always works. But it's a good example of what companies can do to at least sort of improve those chances and curtail sort of in bankruptcy messy and expensive litigation. Managing vendor and customer relationships, we know why that's important. Often companies actually file in large part to find ways to protect these contracts and these relationships. The Diamond Offshore was an example of that. The company filed recently primarily to protect a $1.4 billion contract backlog, for example. You take a company like Diamond in bankruptcy because of energy market volatility, its customers are also impacted by those same industry forces. Customers will usually seek concessions before filing. They may not be familiar with the bankruptcy process. They can get aggressive from the get-go. So managing these relationships ahead can be crucial. And sort of thinking on the same area, if you think back as how we get here, perhaps the bankruptcy that puts concerns about vendors and vendor payments to the forefront of the Chapter 11 case is probably Toys R Us. We have this critical vendor payments that usually have the highest priority. And then we have Toys, where it ultimately faced liquidation and the company was deemed administratively insolvent, unable to pay these vendors. And sort of they face what was deemed perhaps unthinkable, getting paid less than $100,000. So easing those types of fears among vendors and customers is probably one of the most important things for a debtor to do as it contemplates filing. Next slide, please. So there's no single path to bankruptcy. What may be useful is to focus on what's most likely to work. Perhaps nothing too surprising here based on what we were just talking, but the focus of any potential debtor remains probably on just hopefully entering the process, ideally with a prepackaged plan, or most likely with what you'd call a prearranged one. There are companies that enter Chapter 11 with a plan that's already agreed on and has sufficient creditor vote. All they need to do is satisfy certain notice requirements and just move through bankruptcy in maybe 30 days, maybe less. And I think that given the overload that bankruptcy courts may face moving forward, courts may be even more inclined in moving these bankruptcies even quicker during this economic climate. And that's something that could be positive for debtors, and something that we have yet to see, but that's a possibility. So this sort of speedy resolution is probably more typical for strict debt for equity bankruptcies. So basically having class of creditors take over the company and wiping out all the equity. But it doesn't have to be. Sometimes companies will enter a bankruptcy with a prearranged sale, for example, already having a bid, and we call them 363 sales in bankruptcy. And in that case, all that the bankruptcy court needs to do is sort of follow the steps and approve the sale and the company exits. Most often, however, all this isn't realistic. Debtors do file, though, usually file after undergoing significant creditor negotiations ahead of time. In companies where lenders are highly sophisticated, interests tend to align pretty early on. Ad hoc bondholder groups form quickly, and at the very least, parties will exchange confidential information with debtors ahead of time, and even that usually tends to save significant time during the bankruptcy process. Next slide, please. So bankruptcy during and post-COVID-19. So to start off, there hasn't been a lot of time to understand how bankruptcy courts will respond to the current crisis and the likely increase in filings that's supposed to follow. But we do have some hints. And perhaps one of the most striking decisions that some courts have recently taken has been to allow debtors and their cases to quote unquote go dark, granting what are so-called mothballing motions. And going dark basically means allowing debtors to suspend their bankruptcy case so it can provide a breathing spell to just get past the pandemic. There's nothing ordinary about this approach. You could call it a way that bankruptcy judges have exercised immense discretion during this time. They're implemented in part by the court's equitable powers and in part under sort of a rarely used bankruptcy court provision. So it's not grounded in a lot of in really specific code provisions that we've seen before. It's hard, so it's hard to predict how courts across the country may handle this request and what will happen moving forward. But it's worth noting, and probably, and a good example of this was what was the Pier 1 decision, a recent decision, where the court allowed the debtor to actually not pay rent while waiting for things to improve. The company initially planned for a sale that plan fell through, and then the company received permission from the bankruptcy court to withhold rent payments as it waits, just moving out of bankruptcy. Again, quite an extraordinary move. Under the code, a debtor must maintain current lease payment. It's a sort of generic provision, never really questioned, really protects landlords. And where we have a court finding that paying landlords, while the company can neither sell itself nor liquidate, would basically be favoring those creditors or landlords compared to others. Again, just courts exercising wide discretion here and trying to balance the interests of all parties. And even when that may be viewed as potentially conflicting with well-known bankruptcy precedent. Next slide. I think we're going to skip next slide in the interest of time. Just one thing to mention here. One thing that we may be seeing is this, we may be seeing a pattern of stakeholders holding back from bankruptcy litigation around this time. I think we've seen that in Intelsat possibly. And this idea of getting the company in and out of bankruptcy as quickly as possible is probably more appealing than ever now. And we see creditors really just focusing on that. So in this top part, I want to focus on retail bankruptcies. For the average season to get, the retailers just really don't do well in bankruptcy. And there's clearly identifiable reasons for that. And there also, we can look at ways that you can get around those. So the main reason probably is that just the bankruptcy code itself isn't as friendly to retailers. There's heavy time restrictions. Retailers basically get a maximum of 210 days to decide whether to accept or reject the lease. There's just not enough time more often. That's the time that companies have to use to sort of analyze store performances, conduct merchandise changes, implement efforts to improve stores and profitability. So it's a provision that helps landlords, but it clearly runs the risk of lending to faster litigation. Another factor that makes retail bankruptcies sort of tricky is that retailers typically have significant capital tied up in what's probably easy to sell inventory. And this can be problematic for a retailer looking to organize, because to emerge from bankruptcy, a debtor must pass the best interest test. So it would have to prove that each class of creditors does better under a plan of organization than if the company were to liquidate. So in a case like a retailer, if liquidation can be accomplished easily and with good returns, then it can be difficult for debtors to achieve consensus for recapitalization. We'll skip the other factors, but to move on to the next slide. So there's three main options for structural for retail bankruptcy: just debt for equity swap, going concern sale. It's often a combination of the three. I guess to move on to the last one, let's sort of talk about what has changed now. So we spoke about before, we just spoke about liquidation and how comparing a bankrupt retailer's liquidation value with that of a going concern entity is the key to exit bankruptcy. So you can't reorganize a liquidation value is higher than that of a reorganized company. And what makes today so different is that the uncertainties around asset valuations during this crisis will likely make this analysis more difficult. So paradoxically, at this time where the value of the company's asset declines, liquidation may no longer be the best option, which may leave way to a restructuring. And that's because there's just really a number of difficulties here, starting with issues with challenges of pricing current inventory, challenges that come from having to compete with multiple bankrupt retailers in the same space, and the seasonality nature of all of this. Obviously, it's a key driver to retail bankruptcies. Retailers do better, or at least would be ideal for them to file during a holiday sale and see how that drives the process. What works for successful retail bankruptcies, we've seen them, they're there. It's usually those that come in with pre-arranged and pre-negotiated deals with companies that have tested the marketing process beforehand. So 9 West and Claire's are those examples. It doesn't mean that the bankruptcy process is smooth. It could be contentious, but at least for those companies, the ultimate fate wasn't in question because they went to bankruptcy with sort of agreements in place, with the seller in place. Another way that retailers could use the bankruptcy process is for just sort of a narrow purpose. We saw it in mattress firms, so you could use the process just as a tool to target renegotiations or rejections of leases, for example, and matters firm to that and was out of bankruptcy in record time. I guess another element that one has to think about as a factor in retail bankruptcies, it's whether saving jobs and saving the company, what value that has. It's hard to tell, but it played a role, and maybe a large role, in Sears, and it's not necessarily a factor that I would rely on as a key argument to avoid liquidation, but we do have a Sears example from one New York court, so we have yet to see how other courts will view it. I think that's all I have for now. I think, Andrew, I'll pass it on to you.
Okay, so tax. Quick introduction. I'm Andrew Silverman, a tax policy and company analyst at Bloomberg. And as I'm the last to go, I'm going to try to be as quick as possible. I wanted to talk briefly about the Tax Reform Act of 2017 in the light of the CARES Act, that's a stimulus bill, and the recession. So first off, some background. There are two major tax provisions in the CARES Act that are intended to offer assistance to businesses in this recession. The first allows companies to use net operating losses arising in 2018, 2019, and 2020 against taxable income from all the way back to 2013. And so what this means is that the CARES Act gives companies the ability to do a bit of tax arbitrage, to use post-tax reform operating losses against higher tax income earned pre-Tax Cuts and Jobs Act. The second provision gives companies the ability for 2019 and 2020 to take interest expense deductions up to 50% of adjusted taxable income, which is loosely defined as EBITDA. So how do these CARES Act provisions relate to the Tax Cuts and Jobs Act? And maybe more importantly, why do I care? Well, what the Tax Cuts and Jobs Act attempted to do was to reduce business tax rates in a revenue neutral way. In other words, to pay for business tax rate reductions by spurring above average GDP growth, by closing tax loopholes, and by raising new tax revenue, i.e. Creating new taxes. So first off, I should note that the measure of revenue neutrality was determined based on a dynamic economic model, which means that the tax cuts in the Tax Cuts and Jobs Act would only have been negated if the stimulus produced by the cuts created enough growth in the economy, then the shortfall in tax revenue collection due to tax rate reductions could be made up by the amount of new revenue produced by the cuts. Put more simply, the TCJA was only going to be revenue neutral if the tax cuts were able to pay for themselves. So the question is, did the tax cuts pay for themselves? In short, the answer to that question is no. Now, of course, I admit this is a little bit unfair. It's too early to judge. I mean, the Tax Cuts and Jobs Act was supposed to pay for itself over 10 years, and it's not 2028. Yes, true, but the kind of growth that the tax cuts would have needed to produce was likely impossible in the economy at the time that the TCJA passed. And even over 10 years, if everything had gone well, there were other complicating factors, most significantly trade issues, that held down GDP growth in 2018 and 2019 when most of the growth was intended to have occurred. So now we're probably in a recession, and the Congressional Budget Office, which did the original dynamic calculation, is now saying that the TCJA alone will probably add $2 trillion to the deficit by 2028. That's that 10-year term. Now, we discussed the dynamic economic growth aspect of the Tax Cuts and Jobs Act, but paying for the tax cuts was a three-legged stool. What about the new taxes created by the act? Couldn't they make up for the growth shortfall? Well, the TCJA created a tax on distributions out of the U.S., that's the so-called BEAT, and a tax on intangibles that creates a floor, a minimum level of tax on income held offshore by U.S. companies, that's the GILTI. Yet since these new taxes were put into place in 2018, Treasury has substantially chipped away at and weakened both the BEAT and the GILTI. So that's problematic, but maybe not a deal breaker. What about the third leg of the stool, those loopholes that the TCJA was meant to close? Well, that's where the CARES Act comes in. So the CARES Act really kicked out the last leg of the stool by bringing back those two loopholes. Why? Well, because the TCJA was only going to work in a good economy. And just broadly, tax cuts only help companies when they have more revenue than operating expenses. And the ability to expense capital investments, a key part of the Tax Cuts and Jobs Act, is only helpful when companies want or need to make capital investments. And neither of these things are generally true in a recession. So the loopholes that the TCJA had closed were tax allowances that are essential for companies in a downturn. That is the tax deduction for interest expense and the use of net operating losses on a going forward and look back basis. So where does this leave us in terms of tax reform being revenue neutral? Well, we're fairly certain that the tax cuts aren't going to pay for themselves in 10 years. And we know that the new taxes that Congress passed aren't going to raise nearly the amount of money that Congress had originally hoped. And now with the advent of the CARES Act, the GOP tax cuts have really just become revenue loss and deficit spending. So on that pessimistic note, that's about all the time that I have today, but I wanted to leave a little bit of time for questions, but please don't hesitate to give me a call, send me a text over IB, or email me if you'd like to discuss further. So Bruce, were there any questions we could get in? I know we're a little bit over.
Okay, well, Andrew and Yelena and the other Andrew, too many Andrews on this call, and Negesa, thank you very much for your presentation. We are running over our sort of 1 hour mark here. So what I'm going to do is I'm going to see if I can defer the questions till later. I think we do have one question. So let me see if let me just ask that, and then I think we're going to have to go dark ourselves, so everybody has to get back to work. The question is, going dark seems very attractive to debtors. Will this become the gold standard in bankruptcies going forward?
I just think I think that's for me. I think it's a question that we'll get, especially during this time. I think it will be attractive to courts, and they will be willing to allow it for the time being. Though there will always be an element of sort of good faith in all of this. If the court finds that sort of company would be using it just solely as a way to postpone liquidation, if there's sort of no hope there for restructuring, then it's probably not. It won't be that willing to allow it. I think that another thing that may be interesting that we're going to be seeing is that I spoke about DIP loans and DIP lenders, how a lot of these loans will come with restrictions and conditions and timelines. And I think we may have such an option as going dark be a condition to a DIP loan, for example. And it will be interesting how the courts will deal with that. Obviously, they don't have to honor it, but we'll sort of see probably lenders depend more and more on it, at least during this time. As I said, this is completely new. This is not something that is done, or I'm not sure if it's ever been done. So sort of unique to this time, I think.
Okay, thank you. I know we've sort of run over our hour here, so if you do have any more questions, please put them in an email and address them to either myself or to the speakers here on the call. I thank you all for attending, and I will be sending out slides shortly to those who have attended. So again, thank you very much. And if you want to keep up to date, as Elena mentioned, there is a phone number and that you can dial into. I think the economy is one that is dynamic, no longer steady state. So if you want to keep up to date, I think staying in touch weekly is the best way to do that. So with that, I'm going to close the call, and thank you all for attending, and we expect to talk with you soon in the very near future. Goodbye, and thank you for attending.